Hello everyone, my name is Narayanamurthy Poppala. I am a Chartered Accountant and a CFA, and I am the faculty for the CA Final Elective Paper 6B Financial Services and Capital Markets. In this video, we shall analyze and discuss in detail the Jan 2021 FSCM question paper. You must be wondering why we are doing this video so late. Actually, we didn't intend to make this video because by the time we launched our classes, the Jan 2021 exams have long been completed. However, recently, one of our students has requested us to make this video because ICAI hasn't come up with the suggested answers for the Jan 2021 question paper even to this day. And we have also observed that none of the faculty have come up with a discussion video on Jan 2021 FSCM paper. So, we came up with this video for two reasons. The first reason is to provide guidance to the students as to how they should approach the FSCM question paper during the exam. And the second reason is to give an idea to those students who have already given the Jan 2021 exam as to how they performed, that is, where they might have committed mistakes or where they might have lost their marks, etc. Now, before we start discussing the question paper, let me give you a broad outlook on the paper. After the Jan 2021 exam, we have observed that many students went on to Telegram groups and complained that the paper was rather difficult. Yes, the Jan 2021 FSCM question paper was rather difficult to those students who have thought that as this is an open book examination, all you have to do is just search for the answers in the book and write them. For such students, the paper was rather difficult. However, if you have a comprehensive understanding of the concepts, with the right approach and with proper guidance, you can score more than 80 marks even though you are an average student. Yes, even an average student can score more than 80 marks with proper approach and guidance. Smart students and above average students can score more than 90 marks with the right approach. Yes, if you are smart enough, you can score more than 90 marks if you know how to approach this paper. I will demonstrate to you in this video how to score more than 90 marks. If you are an FSCM student, you should be aware that the FSCM subject consists of 17 chapters and 5 SEBI regulations. First, let's discuss about those 17 chapters. If you want to score well in the FSCM paper, you need to have a thorough, a comprehensive understanding of the concepts discussed in those 17 chapters. A surface level understanding of the concepts is not going to help you in scoring well in this paper. Because what ICAI is doing is, ICAI is asking lots of application based questions from these 17 chapters. Sometimes it is asking questions beyond the scope of the ICAI study material for FSCM. So, unless you have a thorough understanding, that is, an understanding at an expert level, you will not be able to score well in this paper. Now, moving on to the 5 SEBI regulations. SEBI regulations are mainly procedure oriented but not concept oriented. That is, there are not many concepts discussed in SEBI regulations. The regulations mainly consist of definitions, rules and procedures. So, you need to have a broad based idea, that is, an overall idea of the regulations, but you don't need to memorize each and every detail of the regulation. By broad based idea, what I mean to say is, you need to know what each regulation deals with, what are the various chapters within each regulation, what each chapter deals with, and what are the various topics within each chapter of each regulation. Of course, when it comes to certain important topics, you need to have a conceptual level understanding, but you don't need to memorize each and every detail. Remember that. So, during the examination, when they ask a question on regulation, what you should do is, you should be able to immediately identify what is the relevant regulation, what is the relevant chapter, and what is the relevant topic, so that you will be able to navigate through all those regulations and go to the specific point and write the answer. Sometimes you should be able to interpret whatever is mentioned in those regulations. So what I am trying to say is, when it comes to the 17 chapters, you need to have a thorough understanding, a comprehensive understanding of the concepts discussed in those 17 chapters. But when it comes to the SEBI regulations, you need to have an overall idea of the regulations. You don't need to memorize each and every detail of those regulations, but you should be smart enough to be able to navigate through all those regulations and go to the relevant point during the examination. You will understand what I mean once we start discussing this paper. Now, how I will be discussing this paper? For the sake of our convenience, what I did is, I classified all the questions, that is both MCQs and descriptive questions, into 5 broad categories. The first category is the direct questions. The second category are application oriented questions. The third category are case based questions. The fourth category are out of the box questions, and the last category are numericals. The first category are direct questions, that is, these questions are straightforward in nature. There is nothing much to discuss about these questions. So when it comes to these questions, I will tell you the answer and I will tell you what chapter this question belongs to, but we will not have any more discussion. The second category are application oriented questions. As these are application oriented questions, you may not be able to find the answer directly in the material. So what we will do is, we will have a detailed discussion on these application based questions. Now the third category of questions are case based questions. That is, you will be able to answer these questions only after reading the details of the case study. The fourth category of questions are out of the box questions. That is, these questions are beyond the scope of the content provided in the ICA study material. Now remember, ICA can ask questions which are beyond the scope of the ICA study material because this is an open book examination and you can carry any material to the examination hall. Now as these questions are beyond the scope of the ICA study material, what we are going to do is, we are going to have a detailed discussion on such questions in this video. And the final and fifth category, that is numericals. I am not going to discuss these numericals in this video. However, I solve these numericals. What you can do is, you can go to our website catalystforca.com and you can download my suggested answers for Jan 2021 FSCM question paper. In those suggested answers, you will find the answers for all the questions including the numericals. By now, you must be aware that the elective paper consists of 5 case studies, and during the examination, you should select 4 case studies. Each case study is followed by MCQs and descriptive questions for a total of 25 marks. Now this point I am going to tell is very important, so please pay attention. Each case study does not exclusively deal with only one chapter or with one SEBI regulation. Each case study can deal with multiple chapters, usually 2 to 4 chapters or SEBI regulations. And sometimes ICA can structure a case study based on 5 or 6 chapters or SEBI regulations as well. So remember this, each case study does not exclusively deal with only one chapter or with only one SEBI regulation. And now coming to the marks bifurcation, roughly 70 to 75% of the questions based on marks deal with the main chapters, that is the 17 chapters, whereas roughly 25 to 30% of the questions are from SEBI regulations. This has been the historical pattern and it is expected that for the next few years also the same pattern is going to continue. Now coming to the Jan 2021 question paper, that is the FSCM question paper, the first case study mainly deals with Chapter 8 Banking, Chapter 15 Credit Derivatives and SEBI LODR regulations. The second case study deals with Chapter 1 Global Financial Markets, Chapter 2 Impact of Various Policies of Financial Markets, Chapter 4 Secondary Markets and Chapter 5 Money Market. The third case study deals with Chapter 10 Private Equity and SEBI LODR regulations. The fourth case study deals with multiple chapters, that is SEBI LODR regulations, SEBI ICDR regulations, Chapter 1 Global Financial Markets, Chapter 4 Secondary Market, Chapter 5 Money Market, Chapter 6 Institutions and Intermediaries, Chapter 7 Commodity Market, and Chapter 14 Risk Management. Finally, the fifth case study also deals with multiple chapters, that is Chapter 3 Primary Market, Chapter 4 Secondary Market, Chapter 12 Credit Rating, Chapter 13 Treasury Operations, Chapter 16 Leasing, and Chapter 17 Factoring. Now, before we start discussing any specific case study, let me tell you something very important. During the examination, how should you approach the case study? Should you read the details of the case study first and then go on to the questions? Or should you read all the questions first and then read the case study? As per my advice, it is better to read all the questions and then go on to the case study. Because what's happening is, a majority of the questions, more than 60% of the questions, have nothing to do with the case study. So, instead of reading the case study, that is all the details of the case study, and most of the details of the case study are actually irrelevant to the questions, it is better to read all the questions first. So, don't waste your time by reading all the details of the case study. Go to the questions and read all the questions and then read the case study. In Jan 2021 FSCM question paper, the first case study is the trickiest of all. That is, the first case study is considered the most difficult. Maybe that is ICA's strategy to test the students' confidence. Anyways, what we will do is, we will discuss the first case study last. We will start with the second case study, which is considered the easiest of all, and then we will gradually move up in terms of the level of difficulty. Alright, case study number 2. First, let's have a look at the MCQs. The first MCQ 2.1, who are the primary stakeholders in financial market? A. Brokers, B. Reserve Bank of India, C. Custodians, or D. None of the above. This is a very simple question. The answer is D. None of the above, because A. Brokers and C. Custodians are service providers, whereas B. RBI is a regulator. None of these are primary stakeholders. So, the answer is D. None of the above. But if you want to cross check, you will find the answer in chapter 1. Now, let us move on to the next MCQ. What does SEC stand for? This is a very simple question. Everybody should be knowing this. The answer is B. Securities Exchange Commission. But if you want to cross check, you can go to chapter 1. Now, let us move on to the next MCQ. Reserve Bank of India is established under which act? This is also a straightforward question. You will find the answer in chapter 1. The answer is A. Reserve Bank of India Act 1934. Now, let us move on to the next MCQ. 2.4. Which index is known as headline inflation rate? This is also a straightforward question. You will find the answer in chapter 2. So, as per the ICA study material, the answer is C. Wholesale price index. But technically speaking, this is not the correct answer, because for the past many years, we are considering, we in the sense India is considering consumer price index, a consumer price index, as the headline inflation rate. But we have to follow the ICA study material whether it is updated or not. So, as per the ICA study material, the answer is C. Wholesale price index. Now, let us move on to the last MCQ. Purchase and sale of securities in open market by a central bank is called. This is a very simple question. You have been learning this right from your school. So, you learned this in your school, you learned this in your CPT or foundation, and if you are a new scheme student, you learned this in CA Inter Economics for Finance. The answer is open market operations, A. Open market operations. Alright, now let us move on to the descriptive questions. Question 2.6. Explain the difference between wholesale price index and consumer price index. This is a direct question. You will find the answer in chapter 2. Now, let us move on to the next descriptive question, 2.7. Please elaborate the functions of financial markets. This is also a direct question. You will find the answer in chapter 1. But please be careful with this question. They are asking the functions of financial markets, not the functions of secondary markets. So, you will find the answer for this question in chapter 1. Now, let us move on to the next question 2.8. What is certificate of deposit? Certificate of deposit is a money market instrument. So, there is a detailed description about certificate of deposit in chapter 5 money market. Now, let us move on to the next question 2.9. Illustrate the difference between exchange rate channel and quantum channel. This is also a direct question. You will find the answer in chapter 2. All you have to do is go to the chapter and write the answer. That is it. Now, let us move on to the next question 2.10. What is liquidity adjustment facility? This too is a straightforward question. All you have to do is go to chapter number 2 and write the answer. You will get full marks. As you can see, all the questions are direct or straightforward questions. Even an average student, to be frank, even a below average student should be able to get full marks for this case study, 25 out of 25. It's a crime if you don't get full marks for this case study. And if anybody gets less than 20 marks, then that person is not eligible to sit for a CA final examination. Remember that. So, you should get 25 out of 25, but in the worst case scenario, you should be able to get at least 20 marks for this case study. Alright, now let us move on to the next case study number 3. First, let us have a look at the MCQs. The first MCQ 3.1. Which one should be the compliance officer for Lister Limited as per SEBI LODR regulations? Option A, a chartered accountant. Option B, a CFO who is a chartered accountant. Option C, a CFO who is a company secretary. Or option D, the legal head who is an advocate by qualification. Now, if you go to LODR regulations, as per regulation 6, a listed entity should appoint a qualified company secretary as the compliance officer. Alright, now coming back to the question and looking at these options, which is the correct option? Unfortunately, none of these options are correct. I don't know who the genius is who actually came up with these options, but none of these are correct. However, if we have to choose one, the closest answer is C, a CFO who is also a company secretary by qualification. Now remember, the compliance officer should be a company secretary, but it is not the CFO who should be the compliance officer. But anyways, out of these 4 options, it is option C which is closest to the answer. Alright, now let us move on to the next MCQ 3.2. The following is an extract from the draft term sheet given by VC2. In the event that company issues additional securities at a price less than the current Series A preferred conversion price, such conversion price shall be reduced to the price at which the new shares are issued. So, they are talking about anti-dilution. This is an anti-dilution clause. What in your opinion does the above language of the term sheet indicate? A, broad based weighted average anti-dilution protection. B, narrow based weighted average anti-dilution protection. C, no anti-dilution protection. Or D, full ratchet anti-dilution protection. The answer is D, full ratchet anti-dilution protection, because it is clearly mentioned that if the subsequent round is a down round, that is, in the event that company issues additional securities at a price less than the current Series A preferred conversion price, this is nothing but the subsequent round if it is a down round, they are saying that such conversion price shall be reduced to the price at which the new shares are issued. So, this is clearly a full ratchet anti-dilution protection. The answer is option D. Alright, now let us move on to the next MCQ 3.3. As per draft term sheet of VC1, the holder of a 75% majority Series A share may require a sale of the entire issued share capital of ABC Private Limited. Which one of the following is correct to describe the above right? A, co-sale right. B, consent right. C, drag along right. Or D, preemptive right. Unfortunately, none of these terms were mentioned in the ICA study material. So, I can say that this is an out of the box question. Frankly speaking, in a term sheet, there are many terms that actually appear. However, in the ICA material, only a few of them were mentioned. Fortunately, in our Catalyst material and in our video classes, we discuss some of the terms like co-sale, right of first refusal, even though these terms have not been even mentioned in the ICA study material. Anyways, now getting back to the question here has not been structured properly. That is, the sentence doesn't make much of a sense grammatically. But anyways, from what I understand from this question, the answer should be option B, concentrate. Alright, now let's move on to the next MCQ 3.4. Which of the following is included in a term sheet? A. Down round, B. Fee structure, C. Exclusivity agreement, or D. All of the above. As per the ICA study material, the answer is D. All of the above. But technically speaking, B. Fee structure should not be part of a term sheet. But I don't know who this genius is who actually compiled this ICA study material for chapter 10 private equity. But anyways, if you are following the ICA study material, the answer should be D. All of the above. Alright, now let's move on to the last MCQ 3.5. One of the audit committee members of Lister Limited has requested for a meeting only among the audit committee members without the presence of any of the company's executives. The newly appointed CFO has strongly objected to this request on the ground that this would not be in compliance with the spirit of the provisions under SEBI regulations, and at least the CFO should be present as the matters being discussed in the audit committee are all related to finance and audit matters. In respect of this, which one of the following is correct in view of SEBI LODR regulations? A. Request by the audit committee member, B. Position taken by the CFO, C. Both A and B, or D. None of the above. Now for this question, ICAI is doing you a favor by giving you the specific regulation, that is LODR regulations. But even if they don't mention the LODR regulations, by just looking at the term audit committee, you should be able to identify that LODR regulations are applicable to this question. But anyways, now let's look at the question. What they are saying is, the audit committee members want to conduct a meeting and they don't want any of the company's executives, including the CFO, to be present at the meeting. But what the CFO is saying that at least the CFO should be present because they are discussing finance matters. So what he is saying is at least one executive should be present and that executive should be CFO. So they are asking whose position is right, the audit committee member's position or the CFO's position. So if we go to the topic audit committee under SEBI LODR regulations, as per regulation 18(1)(f), it is clearly mentioned that the audit committee may meet without the presence of any executives. And it is also mentioned that, and the audit committee at its discretion shall invite finance director or CFO or internal audit head. Now remember, it is not mandatory, it is at the discretion of the audit committee to invite the finance director or CFO or internal audit head. So the position taken by the audit committee member is correct and the position taken by CFO is incorrect. So the answer is A, request by the audit committee member. Alright, now let's move on to the first descriptive question, question number 3.6. Would Mr. Xerox and Mr. Copy qualify as independent directors of Lister Limited as per SEBI LODR regulations? Provide your response with explanations. Now this is a case based question, that is, you have to read the details of the case to be able to answer this question. I provided the detailed answer in the suggested answers. Anyways, just to give you an idea, when it comes to independent directors and their qualifications, regulation 16(1)(b) of SEBI LODR regulations deals with it. So based on the interpretation of this regulation, we can conclude that Mr. Xerox is eligible to become an independent director while Mr. Copy is not eligible. Again, as I said, you can find the detailed answer in the suggested answers provided by me at our website catalystforca.com. Alright, now let's move on to the next descriptive question, 3.7. Is Mr. Lister complying with the requirements of SEBI LODR regulations 2015 for the number of directorships held by him and the number of companies in which he is an independent director? Provide your response with specific explanations. Alright, now this question is also a case based question and you will find the detailed answer in my suggested answers. But anyways, to give you a basic idea of this, regulation 17A of LODR regulations, that is maximum number of directorships, deal with this kind of scenario. Alright, now let us move on to the next descriptive question, 3.8. What percentage ownership should the startup give to VC1, VC2 and VC3 to persuade the VC to invest in the startup? Now this is a case based question, but this is also a numerical. Now let us move on to the next descriptive question, 3.9. How many shares should VC1, VC2 and VC3 purchase? So this is also a case based question and this is also a numerical. So questions 3.8 and 3.9 are numericals and they pertain to chapter 10 private equity. You will find the detailed answer, that is the calculation and explanation, in our suggested answers. So just visit our website catalystforca.com and download the suggested answers. So that was all about case study number 3. So as you can see, the questions are relatively easy. So if you are a smart student, it should not be difficult for you to score full marks, that is 25 out of 25. But if you are an average student, you should score at least 20 marks for this case study. Alright, now let us move on to the next case study number 4. First, let us have a look at the MCQs. So MCQ 4.1. All of the following statements about CDO are true except. The full form of CDO is collateralized debt obligations. Chapter 15 credit derivatives deals with CDOs. So what they are saying is, which of the following statements is false about CDOs? So let us have a look at the options. A. CDO is a form of securitized debt. This is true. CDO is a form of securitized debt, but they are asking which of the following statements is false. So A is not the correct option. Let us go to B. Synthetic CDO does not require actual transfer of assets. This statement is also true. Synthetic CDO do not require transfer of assets. Synthetic CDOs are created through credit derivatives like credit default swaps or credit linked notes. So let us move on to the next option, option C. Arbitrage CDOs are also known as balance sheet CDO. Now let us put this option on hold and go to the next option, option D. Arbitrage CDOs can be broken down into cash flow and market value CDO. Now please understand that in the ICA study material, the topics like balance sheet CDO, market value CDO or cash flow CDO were not even mentioned. But ICA is still asking questions on these concepts because remember, this is an open book examination. So they can ask any questions on the subject matter even though they have not been discussed or even mentioned in the ICA study material. Now I have to accept that even I did not discuss terms like market value CDO or cash flow CDO in our catalyst material or even in our video classes because I thought these concepts would be too complicated for you to follow, especially when they were not even mentioned in the ICA material. But fortunately what I did is, even though it is not mentioned in the ICA material, I discussed the concept of balance sheet CDO and I also explained the differences between arbitrage CDO and balance sheet CDO even though it was not mentioned in the ICA material. Even in our catalyst material, you will find a note on the differences between arbitrage CDO and balance sheet CDO. So if you are my student, you should be able to deduce that arbitrage CDO and balance sheet CDO are two different things. So by the logic of deduction, option C, arbitrage CDOs are also known as balance sheet CDOs, is a false statement. So they are asking which of the statements is false and option C is false, so that is your correct answer. But anyways, let us have a look at option D as well. arbitrage CDOs can be broken down into cash flow and market value CDO. This statement is correct because arbitrage CDOs can be classified into cash flow CDOs and market value CDOs. Alright, now let us move on to the next MCQ. 4.2. The extent to which the financial markets assign a value to the listed corporates against the GDP of the economy is also known as. This is a very simple question. The answer is C, Buffett indicator. You will find the answer in chapter 1. Now let us move on to the next MCQ. 4.3. Which one of the following is money market instrument? A, call money, B, treasury bill, C, commercial bills, or D, all of the above. This is a very simple question. Whether you are an FSCM student or not, you should be able to answer this question. The answer is D, all of the above. But if you want to cross check, go to chapter 5, money market. Now let us move on to the next MCQ. 4.4. The yield curve is inverted. A credit-worthy company considering alternative debt maturity would most likely. So what they are saying is the yield curve has been inverted and a credit-worthy company, that is a borrower, is considering alternative debt maturity. So what does a borrower do when the yield curve is inverted? That is the question. Let us have a look at the options. A, enter into a short-term floating rate agreement, or B, obtain a long-term fixed interest rate, or C, roll over short-term debt at each maturity, or D, obtain a long-term floating rate agreement. Please understand that the concept of yield curve and the different types of yield curve is discussed in paper 2 SFM, but not in paper 6B FSCM. However, in chapter 14 risk management, while discussing about interest rate risk management, I explained in detail the different types of yield curves, even though it was not mentioned in the FSCM study material. I also solved some numericals to demonstrate the different types of interest rate risk, even though not a single numerical has been solved either in FSCM material or even in SFM material. Yes, not even a single numerical was mentioned even in SFM material to demonstrate the interest rate risk. Now coming back to the question, a normal yield curve is shaped upwards to the right, which means the short-term interest rate is lower than the long-term interest rate. When the yield curve is inverted, the exact opposite happens, that is, the short-term interest rate is greater than the long-term interest rate. In the given question, the yield curve has been inverted. So, if you are a borrower, will you borrow at short-term interest rate which is greater or at long-term interest rate which is smaller? Obviously, you should borrow at long-term interest rate which is lower. But now the question is, are you going to borrow at fixed rate or at floating rate? Let's assume that you borrowed at floating rate. So, in the near future, if the inverted yield curve goes back to its normal position, then the long-term interest rate is going to increase, which means you have to pay a higher interest rate in the future if you go with floating rate. So, it is better to go with long-term interest rate but at a fixed rate, not at a floating rate. So, the correct option is option B, that is, obtain a long-term fixed interest rate. Please understand, this question is an application oriented question. So, unless you are in a position to apply the concept, how much ever you search for the answer in the book, you will not find the answer. Alright, now let us move on to the last MCQ of this case study, 4.5. Innovators Growth Platform means the trading platform for listing and trading of specified securities of issuers that comply with option A, eligibility criteria specified in regulation 283 of SEBI ICDR regulations. Option B, eligibility criteria specified in regulation 283 of SEBI LODR regulations. Option C, eligibility criteria specified in regulation 283 of SEBI Act 92. Or option D, eligibility criteria specified in section 283 of Companies Act. See, it's obvious that you don't have access to either the SEBI Act or Companies Act in the examination. But if you are an FSCM student, it is a matter of common sense that Innovators Growth Platform is actually discussed in SEBI ICDR regulations. But anyways, let's start with SEBI ICDR regulations. So go to SEBI ICDR regulations and go for the definition of Innovators Growth Platform, and there you have it. So the answer is Regulation 283 of the SEBI ICDR regulations. So the answer is option A. Alright, now let's move on to the descriptive questions. Question number 4.6. Certificate of deposit is a front-ended negotiable instrument, and if a bank offers an amount of rupees 1000 for a period of 3 months at a discount of 30%, then what will be the yield on that certificate of deposit? This is a simple numerical. You will find the detailed solution in our suggested answers. Alright, now let's move on to the next descriptive question, question number 4.7. One of the participants in the session wanted to know the following questions. Who are foreign portfolio investors and what are their broad categories? The topic of foreign portfolio investors is discussed in detail in chapter 6, Institutions and Intermediaries. Now please be careful with this question because they are also asking what are the broad categories. ICA has recently changed the classification of FPIs in the material, in its study material. So if they are going to ask a similar question in the future, you have to refer the latest study material. Now let's go on to the next question. Who is the regulator of commodity markets in India? It is actually SEBI. Earlier it used to be FMC, that is Forward Market Commission, but right now it is SEBI. You can check out the answer in chapter 7, Commodity Markets. Now let's go on to the next question. What is order matching mechanism? Now you can find the answer in chapter 4 under the topic trading mechanism. There is a clear description of the concept of order matching mechanism. Now let's move on to the next question. Which is the most popular international commodity exchange active for trading 24 hours a day? The answer is London Metal Exchange. If you want to cross check, go to chapter 7, Commodity Markets. Alright, now let's move on to the next descriptive question, question number 4.8. Mr. Innovator had some questions for you. Please provide specific responses with reference to relevant regulations and definitions in the SEBI ICDR regulations 2018. So as it is mentioned here, all these questions pertain to SEBI ICDR regulations, and as you can see here, all these are 1-mark questions. Now some of these questions are a bit twisted, but if you have attended my classes, then these questions should be relatively easy for you because we have already discussed these kind of scenarios in our classes. Now I provided the solutions for all these questions in our suggested answers, but anyways we are going to solve the first question because it is quite interesting, but for the rest of the questions you can refer our suggested answers. Alright, now let's read out the first question. For many terms used in the eligibility conditions, there is no definition. For example, he said the term operating profit, monetary asset has not been defined under the SEBI ICDR regulations 2018. In such a case, he would like to make his own computation but is willing to make the disclosures in the notes to the filing documents. Or should he write to SEBI and seek their opinion on the actual definition to be used? So what they are saying is, some terms like operating profit or monetary assets have not been defined in the SEBI ICDR regulations. In such a case, what should you do? Should you go ahead and compute the total monetary assets and operating profit and then make the disclosures? Or should you write to SEBI seeking clarification of these terms? What should you do? Now obviously, some students are going to say that we have to make our own calculations and provide a disclosure, while some students are going to say that we have to write to SEBI seeking clarification. Actually, both these answers are wrong, because remember one thing, when it comes to regulations, don't try to use your common sense. Try to refer the regulation and find out the answer within the regulation itself. So the regulation itself is going to provide the answer for you. Normally, when it comes to these regulations, they contain the definitions of almost all the words. but if they don't provide any definition for some of the words, then they will clearly mention which specific act or which other regulation you have to refer to understand the meaning of the term. So, if you go to SEBI ICDR regulations, to the definition section, go to the end part of it. Here it is clearly mentioned what to do in this case. So, just write it down as per regulation 212 so and so, and you will get your 1 mark. Now, remember this is just 1 mark, so you need to write only this, you do not need to write anything else. So, that is all about case study number 4. Now, this case study may seem a bit tricky, but if you have a comprehensive understanding of the concepts and if you have the right approach, even an average student can easily score between 20 to 25 marks. Remember that. Alright, now let us move on to the next case study, that is case study number 5. First, let us have a look at the MCQs. So, the first MCQ is 5.1. The cap factor is a leading factor in India. It has sent notice to ABC Limited for repaying the amount paid to ABC Limited as a part of factoring facility because the buyer has refused to pay the bill on due date. The type of facility under which the factor collects back from the seller the amount paid by him in case of non-payment of the bill on due date is called. So, what they are saying is, in case the debtor has failed to make the payment to the factor, then if the factor can collect the money from the client, that is from the seller of the goods, then this type of factoring is known as. Obviously, the answer is very easy, it is option A, recourse factoring. Now, let us move on to the next MCQ. 5.2. Which one of the following is correct about buyer's credit arrangement? Now, understand something, buyer's credit means it is a short term credit arrangement. So, option A is a long term credit is extended to the seller. This is incorrect. Option B, a long term credit is extended to the buyer. This is also incorrect because buyer's credit is a short term credit arrangement. Now, let us look at option C. Buyer's credit are given directly to the buyer, but not to the buyer's bank. This is debatable. The thing is, if we consider the meaning of the term buyer's credit, it actually consists of letter of understanding and letter of comfort. But if you look at the ICA study material, they actually haven't defined the term buyer's credit, but they gave an illustration of buyer's credit in the form of a letter of credit. So, if we consider all of that, then option C can also be considered as incorrect because buyer's credit can be extended to the buyer's bank as well, based on what we have seen in the ICA material. So, now let us move on to option D. The outstanding contractual risk for due fulfillment of the seller's obligation is normally not covered outside the loan agreement by a separate performance guarantee in favor of the buyer. I do not know who this genius is who actually comes up with these kind of run off sentences, because grammatically also they do not make much of a sense, and you will not be able to find such sentences even in your FSCM study material. I do not think there is any such sentence in your FSCM study material. Now, I can understand parts of this sentence, but frankly speaking, I too can't understand the meaning of this entire sentence. But anyways, we already know that A, B and C, they are incorrect. So, by default, this should make option D as the correct option. Alright, now let us move on to the next MCQ, question number 5.3. In addition to the issuer's ability to pay and the strength of the security owner's claim on the issue, which other factor is important in the default risk assessment and quality rating assigned to an issue? Option A, the economic significance of the industry and the marketplace of the issue. Option B, the economic significance of the world. Option C, the economic significance of the country, or option D, none of the above. Now, if you observe here, certain words are used in this question: issuer's ability, default risk assessment, quality rating, etc. So, it is obvious that this question pertains to chapter 12 credit rating. So, if we go to chapter 12 credit rating, here we have the answer. So, the answer is option A, the economic significance of the industry and the marketplace of the issue. Alright, now let us move on to the next MCQ, 5.4. Which one of the following economic phenomena can't be determined by just reading inflation rate? Option A, hyperinflation. Option B, deflation. Option C, stagflation. Or option D, disinflation. What they mean is, which of the following conclusions you can't arrive at by just looking at the rate of inflation. So obviously this is an application based question. You can't find ready-made answers for such questions in the study material. Anyways, let's have a look at the options. Option A, hyperinflation. Hyperinflation refers to a very high rate of inflation. So if you look at the rate of inflation and if it is high, you can conclude that there is hyperinflation. Option B, deflation. Deflation refers to negative rate of inflation. So if you look at the rate of inflation and if it is negative, you can conclude that there is deflation. Option C, stagflation. We will discuss more about this option later. Let's move on to the next option, option D, disinflation. Disinflation refers to a reduction in the rate of inflation. That is, the rate of inflation is positive, but it is very low compared to what it used to be previously. So if you look at the rate of inflation and if it is lower than what it used to be, you can conclude that there is disinflation. So that leaves us with only option, that is option C, stagflation. Now stagflation refers to the combination of stagnation and inflation. That is, the economy is in stagnation, but at the same time, that is simultaneously, there is inflation in the economy. Now we will know the inflation part by just looking at the rate of inflation, whether there is high inflation or not. But how will we know whether there is stagnation in the economy or not? For that, we need to look at the output figures, that is whether there is any growth in the real GDP or real output. So unless we have that additional data, or at least we need to know what we have to look at indices such as IIP, Index of Industrial Production. So unless we have some additional data, we can't conclude whether there is stagnation in the economy or not. So obviously they are asking which of the following phenomena can't be determined by just reading inflation rate. So the answer should be option C, stagflation. Now let's move on to the last MCQ of this case study, 5.5. All of the following statements about the role of a back office of a treasury is correct, except. So what they are saying is, which of the following statements is false with respect to the role of a back office? Option A, independent risk assessment. Option B, delivery and deal settlement of the transactions. Option C, controls on the transaction. Or option D, accounting of the transactions. In our video classes, in chapter 13, Treasury Operations, we had a detailed discussion on the roles and responsibilities of the front office, the mid office and the back office, even though the discussion or content in the ICI study material is very limited. But we had a very lengthy discussion. I have also shown you video clips from a movie called Margin Call to demonstrate and illustrate the responsibilities of the mid office. I have also given you examples of cricket where I compared cricket players to the front office staff, the umpires to the mid office staff and the groundkeeping staff to the back office staff. So if you are my student, it should be very clear to you that option A, independent risk assessment, is actually the responsibility of the mid office, whereas option B, C and D, they are the responsibilities of the back office. So they are asking which of the following is not a responsibility of the back office. So the answer is A, independent risk assessment, because this is the responsibility of the mid office. Alright, now let's move on to the descriptive questions. Question number 5.6. Determine as an analyst of growth securities whether leasing is financially viable for ABC Limited. What would be the break-even lease rental for ABC Limited? So they are talking about leasing, which means it pertains to chapter 16 leasing. This is a very simple question. All you have to do is apply the formula and you will get the answer. So this is a numerical. So we are not going to discuss any more about this question. you can find the detailed answer, all the calculations and all in our suggested answers. Alright, now let's move on to the next question, question 5.7. Advise Ms. Placer on options to delist. Which regulations would the group need to comply with for the same? Can these regulations be applied for all companies in the group? Alright, so they are discussing about delisting. Delisting is discussed in detail in chapter 3, capital markets primary, that is primary capital markets. So you will find the answers for all these questions in that chapter. But if you want to know the answers, you can look at the suggested answers which we put on our website catalystforca.com. Alright, now let's move on to the next question, question 5.8. Provide your inputs on share buyback to Ms. Placer on the below specific matters in particular. Alright, so if you have a look at all these sub questions, they all pertain to the concept of buyback of securities. Whenever the term buyback is used, immediately what students do is they refer the SEBI buyback regulations. But understand one thing, the SEBI buyback regulations are very technical in nature. That is, the SEBI buyback regulations contain the different methods of buyback and the procedures to be followed for each method. That is, the rules to be followed, the appointment of merchant banker, extinguishment of shares after buyback, etc. But you need to understand that chapter 4, secondary market, also contains a discussion on buyback. But here in chapter 4, there is a general discussion on buyback. That is, what is the meaning of buyback? When should companies buy back its securities? Should the investors participate in buyback? And what are the after effects of buyback? So, when it comes to this question, that is question number 5.8, all these sub questions are generic questions. None of these questions discuss about the method of buyback or the rules to be followed, etc. So, the answers for all these questions can be found in chapter 4 secondary market. So, please refer chapter 4 secondary market to answer these questions. Don't refer the SEBI buyback regulations. Anyways, I gave the answers for all these questions in our suggested answers. You can refer that. So, all in all, for this case study, except for 1 or 2 questions which are slightly tricky, even an average student should be able to score 20 marks, at least 20 marks for this case study. Alright, so we discussed 4 case studies till now, that is case study 2, 3, 4 and 5. So if we consider the total marks till now, even an average student should be able to score 85 marks in total, that is 25 marks for case study number 2 because it is very easy and 20 marks each for the rest of the case studies. The total comes to 85. So remember, as I told you at the beginning of this video, even an average student with the right approach and with proper guidance should be able to score more than 80 marks for this paper. But if you are smart enough, it is easy for you to score more than 90 marks also. Remember that. Now, let's have a look at case study number 1. As I told you at the beginning of this video, case study number 1 is a bit tricky. So, many students may not be able to score good in this case study, but still, even though you are an average student, you should be able to score at least 15, may not be 20, but at least 15 for this case study. But anyways, let's have a look at those questions first. Alright, this is case study number 1. First, let's have a look at the MCQs. Question number 1.1. Which one of the following is true about credit derivatives? Now remember, chapter 15 deals with credit derivatives. Anyway, let's have a look at the options. Option A. Credit derivative permit the trading of credit risk but with actual ownership of loan. This statement is false because you can trade in credit risk without the actual ownership of loan. Example, you can do that with synthetic CDOs or with naked CDS. Alright, now let's move on to option B. The key risk driver of credit derivative is credit risk rather than market risk. This statement is true because you have credit derivatives to take care of credit risk, because anyways when it comes to market risk, you have the regular derivatives such as futures and options. Anyways, so this statement is correct, but still we will discuss the other two options as well. Let us go to option C. Credit derivatives do not allow investors to create synthetic loan portfolio without bearing the costs of loan origination and administration. This statement is also false because you have something called synthetic CDO which actually does this. So, option C is false. Now, let us look at option D. Credit derivatives are over the counter derivatives, which is true, the value of which is fully derived from the credit performance of the reference assets. Actually, this part is also true. So, we have two options which are correct, option B and option D. I do not know why they included both these options which are true. I do not know which option ICA is going to come up with finally, but according to me option B and option D both are correct. But anyways, I think ICA is going to say that option B is correct and option D is incorrect because it is mentioned that the value of which is fully derived. They may have objection to that term fully derived and they may say that D is wrong, but according to me both B and D, both of them are correct. Alright, now let us move on to the next MCQ 1.2. Which of the following can be appropriate for credit derivatives? It allows investors to isolate and manage various risks including A. Specific risks such as default and credit spread associated with the issuer, B. Interest risk, C. Currency and or convertibility risk, or D. All of the above. The answer is D, all of the above. You can go to chapter 15 credit derivatives to the topic risk involved in CDOs. Remember, CDO is nothing but a credit derivative, at least as per ICI material, and there you have the answer. Default risk, interest rate risk, foreign exchange risk. Foreign exchange risk is nothing but currency risk. So, you have all of them. So, the answer is D, all of the above. Alright, now let us move on to the next MCQ, MCQ number 1.3. The financial covenants in project financing describe how the loan will be repaid under normal circumstances or may be prepaid under special circumstances. Which one of the following is not an example of affirmative covenants? Now understand something, though the term project financing is mentioned, the question is actually about the covenants, it is not about project financing. And unfortunately, the term covenant was not mentioned anywhere in the ICA study material. But here is the thing, if you are a finance student, you should know the meaning of the term covenant by now. Covenant is nothing but, that is, covenants are nothing but the terms and conditions of borrowing. That is, the covenants are the terms and conditions mentioned in the loan agreement, or these are the terms and conditions which are mentioned in the debenture trust deed. So, there are two types of covenants, positive covenants and negative covenants. Positive covenants are also known as affirmative covenants. So, in this question what they are asking is which one of the following is not an example of affirmative covenant, that is not an example of positive covenant. So, indirectly what they are asking is which one of the following is not a, which one of the following is a negative covenant, that is what they are asking. Now, what is the difference between positive covenants and negative covenants? Positive covenants means what are the conditions the borrower should follow, that is the borrower should satisfy the positive covenants, whereas negative covenants means these are restrictions on the borrower, that is the borrower should not do so and so, those are negative covenants. Anyways, let us have a look at the options and find out which one of these following is a negative covenant. Option A, covenants to secure note equally with other lender, this is a positive covenant. B, financial statements and information, that is preparing the financial statements in a timely manner etc. and providing adequate information, this is also a positive covenant, that is the borrower should follow this particular covenant. Option C, right to inspect properties and books, this is also a positive covenant. Option D, limitation on guarantees and contingent liabilities. This is a negative covenant because it is putting a restriction on the borrower. The borrower cannot provide guarantees or cannot have excessive contingent liabilities. As this is a restriction, it is a negative covenant. So, in the question they are asking which one of the following is a negative covenant. The answer is D, limitation on guarantees and contingent liabilities. Alright, now let us move on to the next MCQ. 1.4. In spite of general denial of risk taking by lenders in project financing, there are certain transaction risks which lenders in some instances may feel comfortable in assuming. This exposure may be in the form of providing additional financing and or charging a higher cost to the borrower. Considering this, which one of the following is correct about the risk which a lender may assume in a project financing? Now, this question to some extent can be considered as an application based question, and at the same time it can also be considered as an out of the box question, because it is relatively difficult to answer these kind of questions. You will not find the answer in the FSCM material, and based on how the question is devised, it is relatively difficult to answer such questions. But anyways, let us have a look at the options. A. Country risk and political risk. B. Availability of permits and licenses. C. Completion risk, or D. All of the above. Now, this is one question which I am not very comfortable answering, but still I will give my commentary on this question. So, anyways, coming to option A, country risk and political risk, it is a risk assumed in international lending transactions. Understand this, in domestic lending transactions you are not going to face this risk. Now, coming to option B, availability of permits and licenses. Normally lenders are not going to take this risk. When it comes to permits and licenses, the lenders should ensure that the borrower have the necessary permits and licenses beforehand itself. So, B is definitely not the answer. C. Completion risk. Now, completion risk is another term used for construction risk. Now, in chapter 8 banking under project financing, there is a detailed discussion on construction risk. See, when it comes to construction risk, what the lender does is, he takes all the necessary steps to ensure that this risk is minimized, but there is no discussion on whether the lender is ready to take up this risk. So, that is the thing. Now, D, all of the above. Obviously, if B, availability of permits and licenses is not correct, D, all of the above should also not be correct. So, it leaves us with two options, A and C. So, as I told you, A, country risk, it occurs only in case of international lending transactions. So, that leaves us with only option C, completion risk. So, I am going with completion risk, but again as I said, I am not very comfortable with this one question. Alright, now let us move on to the next MCQ, 1.5. The board member has a negative view about negative working capital, and they believe that working capital is not being efficiently managed. Which one of the following is correct about negative working capital? Option A, negative working capital is always bad. Option B, negative working capital is always good. Option C, negative working capital for restaurant business of PQR indicates efficient management of working capital with value enhancing characteristics. Option D, negative working capital of the restaurant business of PQR Limited is an indicator of financial distress. So, understand this is a case based question, that is, unless we read the details of the case, we can't answer this question. But I can say for sure A or B is not the correct answer, because understand something, though negative working capital is not desired most of the time, but do not be under the impression that negative working capital is always bad. So, option A, negative working capital is always bad, is incorrect, and option B, negative working capital is always good, obviously not. Most of the time there should be a positive working capital, but in some cases negative working capital could also be desirable. So, A and B, both of them are wrong. So, when it comes to C or D, we have to first read the case details and then answer. So, let us have a look at the case. So here it is mentioned that PQR Limited has one division which successfully runs restaurant business in the Chinese food only segment. The board has observed that the restaurant business has been showing negative working capital and they are not happy about the same. They did not like the explanation given by the CFO of the company that in restaurant business, working capital is generally negative. As a practice, only cash sales are allowed in the restaurant and inventory is not kept for more than 5 days. Average payable period is not more than 35 days. Now understand something, I think the position of CFO is correct here. In restaurant business, you will be having a negative working capital because understand the sales are all cash sales. So after the sale, immediately you are going to get the cash. But whatever you are buying, there will be a credit period for what you are buying. So obviously in restaurant business, in this kind of a restaurant business, you are going to have a negative working capital and it is actually a good thing. So now coming back to this question, option C, negative working capital for the restaurant business of PQR indicates efficient management of working capital with value enhancing characteristics. This option is the correct option. Alright, now let us move on to the descriptive questions. Question 1.6. Find the value of a PQR rate share using earnings capitalization method. Now please be careful, just because rate is mentioned, that is real estate investment trust, don't be under the assumption that they ask questions on rate or on mutual fund chapter, because rate is covered in chapter 9 mutual funds. Don't be under the impression that the question actually pertains to rate or to mutual fund chapter. Actually in the case study also, the term rate has been used multiple times. So if you read the case study directly, you will be under the impression that they are discussing about chapter 9 mutual fund. No, there is no discussion or no question about chapter 9 or about rate. Here the question is very specific. They are asking what is the value of the unit, rate unit, using earnings capitalization method. Unfortunately, there is no discussion about earnings capitalization method because this is a common sense question. Anybody should be able to calculate the share price using earnings capitalization method. So it has nothing to do with chapter 9, remember that. Now this can be considered as an out of the box question because, as I said, in the FSCM material there is no mention of earnings capitalization method. You have to use your common sense to do this. Anyways, as this is a numerical, I solved this question, so you can find it in our suggested answers. Now moving on to question number 1.7, find the value of a PQR rate share using dividend discount model. Again, this is also a numerical. Understand, there is no discussion about dividend discount model in FSCM because dividend discount model is discussed in SFM old syllabus or in CA Inter new syllabus, CA Inter financial management. So in CA Inter you must have learnt how to apply this dividend discount model. So we are going to use the same model and find out the value of this rate share. You will find the answer in suggested answers. Alright, now let us move on to the next question, question number 1.8. The board of PQR is very concerned about the bank they are going to select for project financing. They have hired you to identify and explain factors that would be relevant for the board to consider before selecting a bank. This actually should be considered as an out of the box question, but not entirely out of the box question, but slightly out of the box question, because normally what they should do is they should ask questions like what factors the lenders or bankers should consider before extending the loan to the borrower. But they are asking the reverse question, that is they are asking what factors the borrower should consider before selecting a lender or a bank for project finance. Obviously, the study material does not contain any answer, direct answer for this question. Now you can refer the material as much as you want, but you will not find any answer. However, if you understood the concept of project finance thoroughly, then you can use your knowledge to write this answer. So in my opinion, the factors which a borrower should consider before approaching the lender for project financing are: number one, the first factor is the rate of interest. It's obvious, if you are a borrower, you will obviously be concerned about the rate of interest. Every borrower prefers a lender who charges a lower rate of interest. Now, the second factor, that is, what percentage of the project cost is the bank willing to provide as finance? That is, if you need 1000 crores, how much is the bank, what percentage of 1000 crores is the bank willing to provide? So, that is also an important question. That is also an important factor. So, the higher the percentage, the better it is for you. Now, the third factor that you should consider is whether the bank provide working capital finance as project cost or not. And if they are willing to do that, what is the margin money requirement for that working capital finance? So, it is better if the bank provides working capital finance and demands low margin money. Now, the fourth factor is the collateral that they demand. Normally, in project financing, what happens is the project itself acts as the collateral. But in some cases, the bank may demand additional guarantees or even personal guarantees from the directors. So, one should be very careful with such things. Now, the fifth factor that you may consider is the covenants. We already discussed about covenants previously. So, the borrower should ensure that the covenants are not too stringent, because if they are too stringent, then it will be difficult for him to meet them. Now, the sixth factor is what is the moratorium period. The moratorium period should be sufficient for you, because during the moratorium period you do not need to repay, you do not need to pay any installments. We discussed the concept of moratorium in lease financing, but that concept can be applied here also. Now, the seventh factor that you can consider is the bank's past track record, that is, what type of projects did the bank finance previously and what is the scale of such projects. I think these factors are more than sufficient for 4 marks for you. And remember, you won't find the answer for this question in the study material. It all depends on how well you understood the subject of FSCM, especially project financing. Alright, now let us go to the last question, question 1.9. Is the view of the board regarding approval of related party transactions correct? What are the non-compliances as per your understanding? This is a case based question, because unless you read the details of the case, you can't answer this. But one thing is for sure, when they are talking about related party transactions, which regulation deals with related party transactions? You should be able to identify this immediately. The answer is SEBI LODR regulations. So, you have to go to SEBI LODR regulations, and for this question, actually regulation 23, to be very specific, regulation 23 subregulation 2 deals with this question. You will find the detailed answer in our suggested answers. So, that is all about case study number 1. As you might have observed, there are many questions which are application oriented and there are some questions which are out of the box. So, unless a student has a comprehensive understanding of the concepts, it is rather difficult for a student to score good marks for this case study. So, that was all about the Jan 2021 FSCM question paper. As you might have observed, except for the first case study, that is, if you answer the remaining 4 case studies, even an average student can score more than 80 marks with proper guidance and with right approach. So, prepare well for the elective paper examination and try to score as much as possible so that you can take care of the aggregate problem in group 2. But don't take the elective paper for granted. Don't assume that as this is an open book examination, all I have to do is just search for the answer and write it. That strategy doesn't work. I even demonstrated why it doesn't work. Alright, and remember, even the top rankers haven't scored well in the elective paper. In the recent examinations, they scored their least marks in the elective paper. Of course, it is not FSCM, it is some other paper, but if you take the elective paper for granted, this is what happens. So, have proper guidance and have right approach, you can score good marks in the elective paper. All the best.